Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for the next 30 minutes here on Options Guide TV. Well, happy Hump Day, but more importantly, happy NVIDIA Earnings Day. So every earnings season, all the companies leading up to NVIDIA, they don't matter, right? NVIDIA is everything. Well, just kidding. But in general, NVIDIA is always the last of the Meg 7 stocks to announce earnings. And it's, on the tail end. There's still a lot of retail companies that will be announcing earnings. We usually start off with financials, then we eventually get into the Meg 7, and NVIDIA always finishes everything up. And usually back in the day, all of the Meg 7 and every company out there was just hoping that during the conference call for NVIDIA, they were going to mention their company's name, because that usually was a boost. That meant that you were in the forefront of AI. And nowadays, after the DeepSeek news came out, we actually, I don't know if that is good, because now they're worried that everybody is spending too much money on AI. NVIDIA has solid fundamentals relative to valuations on Meg 7 stocks and just across the board, but it's really been susceptible to news headlines lately. So we've seen the stock getting beat up. Today it's back up another 5% heading into the earnings report. So we're going to definitely do a trade in NVIDIA today, and then we're going to take the time to go back and look at our trade that we recently did in the Russell 2000 index using the IWM. And lastly, we did a trade on Home Depot. People kind of forget about Home Depot, but that stock actually, it turned out pretty well. Well, it's still working, I should say. But the marketplace behaved, if you will, for our skip strike butterfly that we did in Home Depot. So that's the agenda for today. Let's start by looking at the IWM trade. So let's run to the Tradier Pro software. And we see the market on IWM right now is at 218. It is down. It is up about $2.06 on the day. Now, we went out fairly far in time. Interesting enough in that on Monday, when we put the trade together, we saw IWM come down, and let me zoom in on the chart here, and break below the 200-day moving average. So then we had the move to the downside, came all the way down to the 214 level. So this was our trigger. This is basically where our trigger was. And now we're seeing a little bit of strength to come right back in. So I like the fact that we had the downturn, that we kind of confirmed a little bit of a break through the downside. And we actually broke through this low here, but we didn't hang out very, very long. But as I mentioned before, in the Russell 2000 index, it doesn't always behave the way the chartists think that it should. And if we come back and we bounce here and we come back down, that shows even a little bit more weakness in the IWM. It's going to be very news driven, though, once again. And we are long a put spread, and we got a couple of weeks until that expiration date. So we're just going to let this ride. We're not doing bad on the trade. You could actually, this is a strong move to the downside here. We went from 218 down, I guess at the bottom was 213. Wouldn't have gotten out at that point in time, but that obviously the trade was profitable. We bought the 217 strike put. That was our in the money option contract. Maybe it was 218. And then we sold something quite a bit out of the money. So that trade is working out just fine. And market has came back, but I still think we just stay the course and look at that position. Now on Home Depot, let me pull up the strikes for Home Depot. Home Depot announced on Tuesday after the close, and the trade that we looked at doing was the shortest term expiration. And we centered it right. The stock at that point in time was trading at 380. 383. Okay, my eyes aren't as good as they used to be. 383 is where the stock was at heading into the earnings report. We obviously tape at 11 o'clock Eastern time. I'm sure you all have your alert set for Options Guide TV every Monday, Wednesday, and Friday. But we taped at that point in time, and at that time, Home Depot was at that level. We set up a skip strike butterfly. Home Depot came out and had a muted move after earnings, but it was perceived as good. The stock right now is trading at $395.94, and we've had a move to the downside, a move back up. We're back in that range, and we're going to the end of the week. Our expiration date is on the 28th, which is 2 days away. We sold it for a net credit of 15 cents to the account, and we centered it right around the 400 level. So let's go and take a peek at our Home Depot trade. And we might be able to sell it and get out of the trade actually for a net credit to the account. Now, ideally, we'd like it to be closer to the 400 level. Got 2 days remaining.
You have to share the screen again.
Right. Okay. Thank you. Apologize for that. All right. How we doing? Looks good. All right.
Yeah.
Thumbs up. So, well, I guess then we didn't see the chart at all, did we? Let's run back to the chart real quick. So here's the movement on Home Depot since earnings. So the day of earnings was on Monday, the 24th. Is when we put this trade together right here. Okay. And let's zoom out a little bit. And then here's the up move in Home Depot. So it came all the way, almost, well, it moved the expected move. And that's what we looked at before we put the trade together. We got hit right at that 400 level. Would have ideally liked it to stay there, but it's came back down. Now it's 395, but we still have a few more days remaining to expiration. We're up to 22 on that trade. So now let's go back to the trading page and let's look at where our near-term market is at. Applied volatility is still fairly high, actually. If we look at historical vol is 22%. The IV on the shorter-term option contract is 28%. So we're still getting some vol. What kind of helps us out a little bit on this trade, considering we're not in the money. We're not in our 400 strike call option. So our trade here, and if anybody put it on out there, if you want to share your experience with the Home Depot and the skip strike butterfly, let me know. Let me know where we're at. So here's the expiration. I always want to double check, make sure that this matches this. So the 28th is where we're at. Here is the call options. Here is the option grid. Here's where the stock is at. We bought, and I'm going to set it up the way that we bought it, not the way that we unwind it. We bought the 400 strike call. We sold 2 of the 405 strike calls. And then we bought 1 of the 415 strike calls. All right. So at this point, that is trading for a 61 cent net debit to the account. Yep. Debit. Net debit to the account. So if we unwound this position, hold on to everybody take a drink of your coffee. You guys ready for this? Okay. So we put the skip strike butterfly on for a net credit, and it was all over the place. I remember when I first set it up, it was at a 20 cent net credit. And then eventually we settled at 15 cents by the end of the show. Figured that the midpoint was around a 15 cent net credit. So we put it on for a net credit of 15 cents. And then we're looking like we can take it off here for a net credit of 57 cents. We had a $500 margin requirement minus any credits that we received. But remember, this is a skip strike butterfly. So we skipped the 410 strike and bought the 415, which embeds the credit spread that pays for the butterfly. That's why you can get it done for a net credit to the account. And so now if we flip the script, and it might have been better when it hit 400, 400 was actually perfect. That's exactly where you would want it to go. And then you want it to start drifting towards 405 as expiration approaches. So here, if I'm going to click on this, market's really moving once again on me. You would go sell to close, buy to close. I'm going to have to hit open, and sell to close. Okay, these would be say closing, and right now it's showing a net credit of 34 cents. I really like. I don't know why that jumped so much on me. It seems to do it whenever I'm doing the show. That's the risk of using live markets, but also you get the benefit of using live markets, and you see what you deal with on a day-to-day basis as a trader. So net credit is 40 cents right now. So you put it on for 12 cents, you could get it off for 40 cents. If you would have, and I would have personally closed this, and I did say I wasn't going to be doing this trade in my own account, but I would have closed this yesterday when it opened at 400. I would have just hit probably around 10 o'clock yesterday morning. Yeah, that was Tuesday. After the announcement, I would have looked to close once it got close to my strike, depending on where it was at. If I could have sold this thing for $1 net credit to the account, you put it on for 12 cents, you had $5 worth of risk on the trade. A very simple trade. The market goes down, you're fine. The market stays flat, you're fine. It just happened to move up about the expected move, which is where we centered our strikes around. So it did everything it was supposed to do. You can't get mad at Home Depot here. And now if you got the trade on, if I had more than one of these on, if I had 2 skip strike butterflies, or maybe 3, or maybe 5, or maybe 10, right? If I had 2 of them on, I would sell one and I would get out, and then I would let the other one ride, because you're comfortable where the stock is at, right? You put it on for a net credit of 15 cents. Stock's at 395. It's already came up and hit the 400 level and then backed off. You have 2 full days of trading. You have a half day today. You have all day Thursday, all day Friday. See if it can start drifting back towards that 400 level. On Thursday, if it's not getting there, close it out. Get whatever you can for it, whatever you want. But by Friday, it's got to get there, right? If it doesn't get to 400 and it stays below this level, well, it's just going to expire worthless, and you're going to make your 15 cents. So that's the way that I would approach it. Right now, the fact that you can get 60 cents, well, 50 cents now that it's moving. I need to stop looking at the quote. You just need to close out the trade, at least on half of the position. Or if you just did one contract, I would close and just get out. And, fairly low risk. You would have had to move more than a standard deviation in order to get to the 410 level where your risk is at. But not a high reward trade either, right? So you got to realize you got minimal risk. You have 3 scenarios that work out on a skip strike if you can get them done for the right price. You have the scenario where the market goes down, you make the net credit. Market stays where it's at, you can still make the net credit. The market even drifts a little higher. Well, that's that. You might be able to sell it for a little bit more. The market makes the expected move. Well, then that's a home run, right? Because that's going to come somewhere close to the middle strike on your option contract. And then if the market blows away the numbers, or it's perceived to be positive numbers, then the market could maybe run to 410. And what you really hope is that it doesn't happen on a gap opening position. So if you have realistic expectations that you're not putting this trade on hoping to double your risk capital, right? Like you would if you were buying a call option outright. It's an interesting trade in a stock like Home Depot, which is a retailer, and they're going to be fairly. This is a type of company that I'd want to do this trade in, right? I don't want to do it in a semiconductor stock where news could slap it, pretty hard, a lot harder than usually you would see in a retail space. Not saying that you can't get blinded by news or get blindsided by news headlines in retail, but it's a lot less likely to happen than it would be in a semiconductor stock. All right, enough said. Any questions on that? Let me go check out. If you have any questions, please do put them in the chat box. There's so many different platforms. I'm not even going to try to explain what platform you might be in. But if there is a chat box, if you toss it in there, it'll eventually get to me. Out of all the different platforms that you can watch Option Guy TV on at this point and time. There you go. Jerry sharing a little bit. Sold for $39 net credit. All right, I'm up 39. Okay. All right, so you put the trade on for 15 cents, Jay, and then you took the trade off for a 15-cent net credit. Then you took the trade off for a 39-cent net credit. That's the way that I would, 49. Okay, 49 makes sense, right? That's where it's at right now, actually. Okay. Thanks for sharing, Jay. I appreciate that. All right, now, the big event, right? NVIDIA earnings. So I go back and forth. I did a trade on a different platform yesterday, or a different show or event or whatever, saying I wanted to get bullish on NVIDIA yesterday. But then again, I would normally trade around earnings. And of course, the stock is up $6 today. So the trade that I was looking at that I wanted to put together, I'm going to have to move everything up. And I'm not happy about that. I wanted to get bullish on NVIDIA. I still think that the conference call will be big. There are news headlines that can blindside the stock at any second, especially with the tariff news that's coming out of Washington, and actually just the news in general about semiconductors and everything else. I didn't think the DeepSeek news was a very I thought it was a little bit overblown on NVIDIA, and it was a buying opportunity. As a matter of fact, if you go back to the President's Day, I did a deep review of a trade where you can hedge your 100 shares of NVIDIA, bring in a net credit, but then own NVIDIA through a certain price range, basically on margin. No additional risk to the account. It's called, I think the title of the webinar, it was on Monday, the President's holiday, is NVIDIA covered call on steroids. So if you have NVIDIA stock and you do feel bullish, even if you feel bearish, it doesn't necessarily matter. But your biggest concern with that strategy is that you could potentially get pegged on the NVIDIA on the upside. If the underlying stock flew through your highest strike price in there, it's like a covered call position, and you could get the stock called away from you and miss out on, if NVIDIA, because, NVIDIA's made 20-30% moves after earnings. So that is your risk of the trade, but it's an interesting trade. So if you own 100 shares, here's the moral to my story, and then I'll stop talking about it. If you own 100 shares of NVIDIA, go back and look at that seminar and look at that trade and decide if that's something you might want to do. Now, I'm just going to get speculative on NVIDIA, flat out. Stock's at 132.74. We're going to go a little bit up. So first of all, we need to know where now remember, we're using the February option contracts. I'm going to do a bull call vertical spread. So I'm going to go out to the March contracts, but I want to start in February because I want to know what the expected move is after earnings. And by doing that, you need to look at the long straddle. So we're going to buy the 133, which is the most at the money. And over here, we're going to buy the 133. So right now it's saying about 12 points. So that's actually jumped a little bit. Just last night when I put it together, it was trading around $11. So we're talking about 12%. That's a big move in NVIDIA, at least a big implied move. It's a move that NVIDIA can easily make. But the marketplace is implying about a 12-point move. So I want to add that into my outlook here, right? So 12 points on adding to 133, that gets you up to 145. All right, so keep that in mind, that the expected move is around 12 points or around 11 or 12% on the underlying stock. Now we're going to go to the March expiration. The at the money straddle is going to be worth more. And ideally, if you're using the March expiration, you usually look at the straddle for that expiration. But I just want to know what's up with earnings. You got 2 full days for it to trade. You got all day Thursday, all day Friday after the earnings event tonight. Okay. So 145 is the high side, right? So I want to go about 7 points in the money up to the 140 level. So I want to make sure that if I'm buying a call option, and this is speculative because we're buying an out of the money option, that the marketplace thinks that it can get there. And I want to go far enough out of the money that I don't want to spend a lot on that trade, right? Because this is a real risky trade. And a lot of times, like on Home Depot, we did a fancy skip strike butterfly where there were 3 different scenarios that could happen after the earnings where you made money. This one, we need a bullish move, and that's it. So you don't know what's going to happen with NVIDIA. The stock's been beaten up a little bit. It could be an opportunity. As a matter of fact, you might just wait and hope that it goes down and buy some more shares if you wanted to, if you want to get bullish, because the fundamentals are still fairly strong and the growth is there, and the valuation isn't horrible relative to the rest of the people in the space. But if I look at this, based off of their growth, let's just put it that way. So 132 just moved down on me. Let's buy the 139. And here's what I like about NVIDIA here is we can go way out of the money and still get something. We're going to buy this option contract. So I moved it down one. I was going to look at 140. And I want to move 10 points. And we're going to sell the 149. 149 is at a 20 delta. So they're saying there's a 20% chance that it will get there. That's 10 points. Yeah, I like that. Let's do that. I was thinking about doing 140 and 150 and keeping it simple just because nice round numbers, but here we go. Hit this one. So we got to close this out. Still got my straddle line here. We're going to buy this and we're going to sell that. Now look at the premium that we're getting on this option contract. We're paying $139. We got to pay up for that, $4. And I wouldn't want to buy that outright, just implied volatility crunch. We know that the expected move is around 12 points. And we know that our math tells us that from 139 to 132 is 7 points. So the marketplace does think that it can get there and go beyond. If it does what the over-under is, it's another line that I like to use for the expected move around straddles or around earnings, is if that just happens, if it's perceived as positive and it moves that much to the upside, that's going to put our stock up here right around 144, 145. Fair enough. I'll take that. I'll take that gain. I'll have a solid move in this underlying. We're only going to pay $2.71 for this. That's where our midpoint is at right now. Let's make that the official number that we're willing to pay for that. You don't want to use a lot of risk capital on this because, once again, it's got to go up. If it just kind of goes up, this isn't going to help you out very much. You got 2 full days for it to trade. You need the market to go up to, actually, we're going to go out 9 days. And it's part of the reason why I want to go out 9 days is because this is more speculative. The shorter term trades like Home Depot, we only went out a few days because they announced on Tuesday before the open, is because we had more scenarios. We wanted it to expire because we had more scenarios where we can win. Here, we want to give ourselves a little bit of time. That's where we're at. Fresh Prince came out and said that you just sold yours for 55 cents. Solid print, solid Fresh Prince. I like that. All right. And Doug's sharing what he's doing with his stock. All right, Doug, watch the video, Doug. I'm going to suggest, because you could do both of these. You could even sell a call on the upside, but yeah, worried that, what if it does do double the expected move? But Doug says, I own it. I own shares of NVIDIA, and I'm doing a put debit spread as opposed to buying a put spread outright. I actually talk about that strategy on NVIDIA after the DeepSeek news came out. But that just means that Doug is going out maybe 7 days. It doesn't really matter, Doug. I'm not going to get into that much detail. But you're going to buy a put somewhere around where the stock is at, and then sell another put further out of the money. And I don't mind that at all, because I'm looking at the skew here in volatility. You're buying an option that's maybe got a vol around 87. And if you're selling something down here, you're getting a vol about 90. And that will have a tendency to happen, especially around an earnings event. You'll get a decent amount of implied volatility skew. Some people call it tilt. Tilt's usually between expirations. But if we look at this, this is where we're at. 187 down to 90. Yeah, I don't mind that trade, Doug. I don't own enough shares to sell a cover call. Okay. All right. That's fair. That's fair. Nothing wrong with that. All right. So back to my trade. Here's my, so $271. That's the maximum risk. And I love the fact that we are getting $1.75 all the way up at 149 with the stock at 132. Now, interesting enough, okay, and I'll paint this picture because we do got the show on Friday. If the stock, like, let's say the stock moved to 137, you know what I might do? We're far enough out of the money that, and with the implied volatility crunch, that this could actually go close to zero in that scenario. Say we moved half of the expected move. We got up close to the strike. I might actually close this if I could buy it back, let's say for 20 cents and sell something closer, right? Sell the 144, which it would be 5 points away. Make this a 5-point wide spread instead of a 10-point wide spread, and bring in a little bit more premium to try to bring down some of this initial cost. Now, that's one scenario where it moved half of the expected move instead of all of it, and it was perceived as a good thing, their earnings report. But that would be my adjustment. So we'll look at Friday. We'll be around. We'll be able to check this out on Options Guide TV. And any more questions or comments? All right, Doug, I like your comment. He's actually using the delta to try to hedge it. So you're looking specifically at the delta of the put spread and trying to offset the number of shares that you own. That's awesome. So that's actually a better protection than just, you're going to get more protection than you need relative, right? Because you have less shares and you're going to be buying one contract that represents 100 shares. And then you can just close it and get out if the market does go down. And all right. Did you put that one up? I think we did. Yeah, I'm going to show it one more time. Let me click on it. Okay, so this is what Doug said, and that was the comment that I was replying to. I'm position delta hedging, which is way beyond the scope today. Let's get bullish on NVIDIA. Don't risk too much because, first of all, I don't usually do trades where we're so far out of the money around an earnings event, but it's an interesting time to do it. And stock's down. Who knows? Stock moved up. It looked a lot better yesterday, obviously. But I can't. We tape Options Guide TV at a certain time during the day, so we got to use the market quotes for that time. Not bad if you want to see where NVIDIA ends up today and do it a little closer to the close. But you'd use the same type of concept. Look at the expected move. Make sure that the option contract that you're buying in your long call spread is within that expected move. In other words, it's got to get to that strike and beyond, and the marketplace has to think that it will. So you're going to take what the marketplace is giving you. They're giving you information about what they think the underlying can move after their earnings. And the marketplace, the reporters, the market in general calls that the expected move. I don't want to buy something right at the expected move. I don't want to buy the 144, if you will. That's 12 points. 144 at this point in time, because it's the marketplace saying it's just going to get there, right? That's what the marketplace is expecting, is that the stock would just get there and not go above and beyond, and it'll be somewhere within that range by the end of the day. I want to give myself some upside, and so if you adjust it and you wait till the end of the day, adjust it accordingly. I don't mind what I sell out of the money. That's fine. That equates to your risk. Obviously, you sell something a little bit closer, you get more premium, you get lower cost, you have lower overall risk. But if I'm going to do this trade, I want to get rewarded, right? So 270, I got the potential to make 730 on the trade, and I'm risking 270. So I don't mind that risk reward. And I gave you an alternative if the market does After the earnings date, if the market kind of goes there, maybe you take this option contract, close it, and sell something tighter. Maybe if you get half the move of what is expected. All right, I'm going to leave it there. I feel like I'm getting a little wordy. I'm a couple minutes over. Thank you for stopping in. Options Guide TV. Please check us out. We can watch it inside the Tradier Hub, hub.tradier.com. You get access to all the great speakers inside the hub. Make sure you set up a profile so that you can ask questions for all of these events. It's 100% free to set up a profile. And then obviously you can watch it on the Tradier YouTube channel. You can watch it through my x.com feed, which is at Brian Overby, and also through the TradierX.com feed. Thanks for stopping in. We'll see you Friday, 11 a.m. Eastern Time for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.